Then, I want us to do now a good example that will be able to explain the normal loss. ABC Limited produces and sells a certain type of insecticide, YMX, that is the name of the products. In the year just ended, ABC material input into production process 1 was 2,000 units at shillings 10 per unit. Labor cost incurred amounted to 30,000. While overhead cost absorbed amounted to shillings 20,000. The normal loss in the process is 5%. Full stop. Compute the cost of spoilage and the cost per unit of output transferred to process 2 after reassigning the normal loss cost. So, we're going to prepare process 1 account. A process account looks like this. Details, cost per unit, and amount. Details, cost per unit, and amount. Okay? So, here we have the name of the company, ABC Limited. Then, if the question has the dates, you put them here, the details, the date. So mostly haitakuwa. At this level, I know you're going to post the dates, okay? Materials tumekuwa ni how many units? So this one you can label them. Units and the amount. How many units? 2,000 units at shillings 10. That is 20,000. So, at the 3 columns. Units, cost per unit, amount. Fine, hatuna vitu nyingi. Labor costs, tumekuwa ni ngapi? 30,000. Overheads? 20,000. Then, the normal process loss is how much? 5% of what? Add this. So this one has given us a total of 70,000. And this both sides are 70,000. But you have calculated the normal loss. Imekuja ngapi? 3,500. So this is what we are going to transfer to process 2. How much? The balancing figure. 66,500. And then the normal loss in the process is 5%. Our normal loss is 5% of 70,000. You get 3,500, isn't it? It's also 5% of 2,000 units. So it's just 2,000. So this one is shillings, and this is how many? 100 watts units. So normal loss is 100 units. That means these are how many units? 1,900. Okay? Because we input 2,000 units. We are expecting, if we input 2,000 units, we are expecting 2,000 units. See here? Lakini sasa zimekuja 1,900 because of the normal loss. Sini rahisi. Let's continue. Abnormal losses. Abnormal. This is a normal loss. Okay? abnormal losses. Abnormal losses and gains carry their own costs and will be valuable at the cost of good output. They are separately analyzed and the amount transferred to the income statement. So these costs do not add any production benefit to the company. They are treated as accounting losses for income statement. So they are controllable losses which are not expected to occur under efficient operation. So these are things that you can control. So when we find that you are getting abnormal losses, what do? We put controls to ensure you don't do that kind of losses. You don't get that kind of losses. But when they occur, that will be the operating losses. So the cost of abnormal spillage could not be included, included in process costs, nor included in inventory valuation, but it should be reported separately as abnormal loss, which is written off directly as a loss in the period in which they occur. So they are treated as loss in the period which they occur, in the income statement. So, abnormal gain. In some instances, the actual output may be greater than expected. Or put in other words, actual loss is less than the normal or expected loss. We have an expected loss of 5%, isn't it? But right now, the actual we have incurred is less than 5%. That's an abnormal gain. Okay? So in case where abnormal gain has no scrap value, then the cost is expected. The cost per expected unit is equal to input costs. Yeah. When we have a abnormal gain illustration. In August, 2,000 kgs of raw materials were introduced in the process. Here, I want us to understand how to account for the abnormal gain or abnormal loss, whichever. So when you calculate, that is when you know whether it was an abnormal loss or abnormal gain. Because you have been given the normal loss. So if it is more than the normal loss, that is abnormal loss. If it is less than the normal loss, that is an abnormal gain. So, first thing that you need to know is the input costs. That's the scale for normal loss. So the input costs, what do you reckon? 2,000 units at how much? 2,000 units at 6 shillings. Plus what? 200 hours and 15 shillings per hour. That is labor. 200 times 15. Overheads are absorbed at a rate of 4 shillings per labor hour. So, overheads will be what? 200 times 4. Is it clear up to that point? This is the input costs. Then we minus so this one we call it input costs less sale of normal loss. This is materials, labor, overheads, minus 100 times 0.9. This is metaphor. You can see each one of them. Normal losses are incurred at the rate of 5% of input. So first of all, I have calculated the 5% of input. So that's what I've got what this 100 here. Okay. Then the value of the normal loss you have been given, it can be sold at 0.9. Then you have 1,800 units were produced. So how much is this? 710. Then expected output 2000 units times, why 0.95? Because of the 5% loss. So we are not going to get the 2000 units, we are going to get less. Okay? This one will give you what? 1900. Okay? But actual output is equal to 1800 units. That means we have what? Here, abnormal loss. In other words, we are saying we have input 2000 units, we are expecting 5% loss. But the actual output was 1800. That is abnormal loss. That is how we calculate for abnormal loss. So if this was more than this, then it would have been abnormal K. That is it. So cost per unit is there. Our cost per unit we are going to get from here. This one 15,710. 15,710 divided by our units. Our units that we are expecting 1,900. Then it will give us what? Remember to put shillings, where shillings is appropriate. So these are units. This is shillings. Okay? This is shillings 8.2 something. Yes. Okay? Yeah. Now when you have come up with that, you can go ahead and draw your process account. So we have material. Materials, you have 2000 units at that much. Is it at 6? Get 12,000. What else? Labor, 3,000. Then we have overheads. Our overheads, it's at 800. On the other side, transferred to finished goods, we have 1,800 units, isn't it? At how much? Yeah, that's why I was saying I needed 3 columns, even here. Units, cost per unit, and amount, isn't it? So these finished goods are at 8.27. Okay? Then normal loss. Normal loss, we have been told that it was sold. See there? Normal loss. Can put in bracket and say it. Sold as scrap. It's at 100 units, isn't it? At how much? At 0.9. All this you had calculated. Okay? This is 90. This one I need the figure. Abnormal loss. Abnormal loss. Abnormal loss. It is 100 units at 8.27, which will give you 827. I'm waiting for this. Is it 14,883?
Yes.
14,883. Then add here, you get what? $15,800, isn't it? 2,000 units, 15,800. Then you can open the normal loss account. The normal loss account. Double entry of this. Get this. This is process account. We have 100 units. This is 90 bob. Then we have what else? We sold it for cash. Okay? 100 units at 90. Our normal loss account is like that. And probably you can still have the abnormal loss account. Like that. Then double entry of this process 827. How many units? 100. And then these units are sold for cash. 100 units at 90, at 0.9, that's 90. Then the other one, we'll take it to the income statement. Look at this, balance this. This is 800. The balance carried down, you take it to the income statement. It will be the normal loss that we have said. It will be accounted as a business loss. So it is 737. That's abnormal loss account. We need another illustration. So go to August 2023, question 1. August 2023, question 1.